The Federal Reserve keeping interest rates unchanged according to its October statement, but could Thursday's weak GDP report delay a rate hike into 2016? Let's bring in Michael Hewson, Chief Market Strategist at CMC Markets in London. All right, Michael, how do you see it? I mean, what does this latest GDP reading, up 1.5% during third quarter, which was a lot less than the 3.9% during second quarter, what does this mean for the Fed?
Well, I think it raises two questions. The first question is, why was the Fed so hawkish last night, given the recent weak data that we've seen? Are they seeing something about the US economy, that GDP number, the weak durable goods numbers, the weak manufacturing numbers that we've seen over the past few weeks and months? And more importantly, I think the weak PCE numbers that we saw as well for the third quarter, they dropped from 1.9 to 1.3%, and yet the Fed seems to be fairly relaxed about the inflation outlook. I think last night's Fed statement was more about messaging than anything else. I think they wanted to keep the option of a December rate rise on the table, even though the data currently suggests that they're probably not going to do anything.
Right, and we'll get to inflation in just a moment, but speaking of a hawkish Fed statement, the statement on Wednesday said that the central bank is, quote, monitoring global financial and economic developments, which we're largely referring to that slowdown we saw in China a few months ago. But in September, it said these developments could actually hurt economic growth. So they seem to be less concerned about it. I mean, what do you make of this change?
Well, I don't think anything has changed, which puzzles me a little bit with respect to the change of tone with respect to the Fed statement. I mean, if you actually look at the data that we saw in the lead up to September, I would suggest it was much better than it is now. And yet in September, we got a dovish hold. Today or yesterday, we got a hawkish hold, and yet the data is arguably worse. And yet for me, I don't think anything has changed. If anything, what the Fed have done is, by implementing what the markets are perceiving as a hawkish hold, is they're implementing a tightening cycle that is going to make it that much more difficult for them to raise rates in December when that meeting comes around, because you've seen a significant sell-off in the euro and you've seen a significant tightening or raising in bond yields.
Right, but you would think, though, I mean, the Fed's statement was only about 16 hours before this GDP report, so you would think at the time of them preparing the statement that they knew that this GDP report would be weak.
Yeah, I mean, you have to, and it goes back to my previous point about messaging. I think the Fed statement was more about messaging than intent. They wanted to bring the December rate rise option back to the table. We're still data dependent, but I think in terms of the Fed funds rate, the percentage was around about 32% likelihood of a US rate rise in December. We're now back up into the mid-40s, and I think it's that more than anything else that the Fed was trying to achieve with its hawkish statement. My concern is that by doing that, they're actually making financial conditions that much more difficult.
Yeah, and of course they reference their next meeting in the statement, which of course would be December. There is no November meeting. Just real quick, I mean, inflation is certainly not going to pick up over the next 6 weeks, so that would presumably believe that if the Fed is going to hike in December, they would have to look past weak inflation.
If the Fed were going to hike in December, and we know that they want to, they would definitely have to look past weak inflation. And I think that more than any other reason is why they won't.
All right, Michael Hewson, CMC Markets in London. Thanks so much for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.